Hey, everybody. Welcome to a new episode of Unstructured Unlocked. I'm co-host Michelle Gouveia.
And I'm co-host Tom Wilde.
And we are thrilled to be joined today by Sam Worthington, Managing Director of P&C Technology at Aon. He is joining us from London today. Sam, thanks so much for taking the time to talk with us.
Thank you, Michelle, and thank you, Tom. And it's good to see you both again.
You too.
Excellent.
Before we jump into the long list of questions that we have for you, that was a very pithy intro on my part. So it'd be great if you could share a little bit more about your background, your experience, what it is that you are responsible for at Aon. I think that would be great.
Well, yes. Well, thank you for inviting me to your Christmas special. I hope I can do it justice.
Exactly.
So I'm Managing Director of P&C Technology within Aon. So under my remit, I look after the technology that we license to the P&C market for financial modelling. So that includes the Aon pricing platform, which we use for pricing, the Tyche and Remetrica modelling platforms, which are used for capital modelling, reinsurance optimization, and those are the primary pieces of software that we distribute to the market. And as part of that, I work closely with my colleagues in other parts of the business. So we have a lot of other technology, such as impact forecasting, which does event response and CAT modelling. We have a lot of analytics that supports the risk transfer for our clients.
Oh, that's perfect. Well, we have a really interesting topic with you here today. I think and certainly given the remit you have at Aon, the topic we want to talk about today is sort of the intersection of data and analytics and technology and climate risk, right? And how that risk gets modeled, anticipated. How do you work with your clients to help them think that through? And what role are, kind of the rapid advances in technology playing in that particular space? So that's kind of our large topic today. Certainly a meaty one we can get into here, and Aon plays a critical role in helping your customers be smarter about these things and managing risk across the board. How are insurers adjusting their approach to pricing risk with respect to extreme weather events? What used to be kind of 100-year storms have become 10-year storms, and 1,000-year storms have become 100-year storms. What are some of the trends that you're seeing in sort of the claims exposure related to these kind of impacts?
Well, it's a great question, Tom, and it's very topical given the events of the last year and before. And certainly we've seen large losses due to cat perils in the US from things like hurricane and flood and wildfire and severe convective storm. And while we can observe the effects, which is these series of large events or insured losses, if you want to think of it in that term, actually when we drill into it, there's a combination of factors that are going on. Now, one part of this is climate change, but actually, and certainly in many cases, a bigger cause of this is actually the change in exposure due to increased urbanization. So if we look at things like hurricane and hail, that's more a reflection of the change in exposure that we're seeing result in larger claims than we've seen historically. So hail's a good example where we've got the big rise of solar farms. With a lot of solar panels, those are especially susceptible to hail. It's not because the way that hail manifests itself has changed so much, but rather the growth of those solar farms that's doing that. So it does make it difficult to identify how much of that signal of what we're seeing is actually down to climate versus to other factors. But certainly there is a strong signal that for wildfire and for flood that there's a climate element that is causing that. As we see the heating of the planet, which is incontrovertible, it naturally plays into the growth, the severity, and the propensity for those types of events to occur. Of course, those are always bound up as well with changes of exposure. As we have greater urbanization from a flood perspective, well, actually, that means there's more exposure in the first place to loss. Secondly, the natural defences that we have allowing water to drain away are reduced. So those play into that. And with wildfire, this spread of properties, more widely across the country means that into rural areas means that they're more exposed to have losses. And then, I suppose, coming back to your question, how do insurers deal with that? How do they price that into the business that they're writing? Well, that's something they've been doing for decades, using CAT models. And I think, so although that work is always, that's a well-known and common repeatable task for an insurer, the challenge for them at the minute is how do they validate those models? How do they validate the accuracy in light of changes that we're experiencing? And in the context of that changing nature of the risk and the exposure.
So I think that last point you made is really interesting, especially in my world, in the VC world, because we're starting to, with Gen AI, and there's always been a focus on climate, right? Climate risk and assessment. And it's obviously a massive topic for the insurers. And there's a lot of just entrepreneurial activity and technological activity happening there. But one of those key questions that it always comes down to is, what is different or better about your data or the predictive capabilities that makes it a stronger solution or more predictive than maybe what else is out there? And so would be interested in your thoughts on how has the data analytics landscape changed maybe over the course of the last 5 or 10 years as it relates to climate data? So what's available, solutions that are kind of retroactively testing their capabilities against historical, but obviously that's in climate, that's not necessarily predictive of what's to come over the next year, 5 years, 10 years. So I'd be curious your thoughts on solutions that are indicating that they can be more accurate.
If we start by looking at what is the challenge, then we can think how technology and data actually help us to solve that. So fundamentally, the challenge is that the nature of risk is changing. And so historical experience is a guide, but is not predictive of what could happen, especially in the context of very volatile events that are infrequent, and we don't have, and the data set that we've got to work with is pretty sparse if you think about, related to recent exposure. Mm-hmm. So that's the challenge that we've got. And it helps me to think in terms of deconstructing the problem and in the way that a CAT model would do that. So if we look at the components, there's an exposure component, there's a hazard component, there's a vulnerability component, and a financial component. So if we think about those, so there's modeling the underlying hazard itself, which is the storm, the frequency with which a storm or a wildfire or hail might occur in a particular location, following a path or covering a certain geographical area. And then, so there's modeling that element. Then you have the vulnerability. So modeling, well, where does that go to? What does it affect? What gets affected, during that? And then the overlaying the exposure to work out, well, what gets damaged due to that event. And then we have the financial element, which is overlaying insurance structures or reinsurance structures to say, given that, what is the loss that actually is incurred from an insurance perspective versus that which is retained by the company or the customer that's in question. And if we look at those elements, what we can see is data and technology have really helped us in some of those areas more than other ones. So from a hazard perspective, modeling the frequency of these rare events and what those look like, there's a lot of uncertainty to do with that, especially with something that's an unstable environment, with something which is involving climate change. So technology can help us a bit, and I'll come back to that in terms of that core element. But to my mind, it's to a limited degree. When we think about things like the vulnerability and the damage that gets caused relative to exposure, well, actually, there's some big improvements and some advances that we're able to take advantage of. So first of all is that exposure mapping. So advances in geospatial mapping, in LiDAR, being able to identify buildings and their characteristics, that helps us a lot in terms of modeling. If you have an event around that particular area, what gets affected. And the financial modeling component is one that's been able to be done well for a long time. So there's no particular great advance in that area, but there hasn't needed to be. And what we can see is that the other thing that we've got is for events like flood, we can use advances in modeling for predicting where does that flood water go. So for a given size of let's say a dam breach or a given volume of pluvial flooding riverizing a certain level, we can predict with much improved accuracy where does that water actually flow to, and therefore what are the buildings that will be affected by that. So then I'll come back then to the sort of that modelling of the hazard in the first place. What we have seen in recent years is a growth in startups forecasting absolute losses for the industry, and with a limited data sample, actually with some better accuracy than we've seen from the traditional. So for example, modeling, predicting how many major hurricanes will we have in the US. So we have regulatory and meteorological bodies in the US that have forecasted that. And actually, some of these startups have proven more accurate. So a bit built on the back of machine learning and analytics. So I see areas of improvement, and I see areas where it's still very challenging to do.
You raised a really interesting point that I hadn't really thought about, and maybe I'd ask the question this way. Are we at greater risk, or are we doing riskier things? For example, building solar panels in the plains of the United States. Well, to your point, hail's been in the plains of the United States, since the Earth was created. I just read this really fascinating book, and it's funny that, focusing on the insurance industry, but reading a book like this, it's called Fire Weather, and it's all about the famous Alberta fire where they're doing the fracking, right? And there's this huge town that kind of bloomed out of the forest to support this fracking activity. And the reality of the boreal forests across Canada is that by design, they burn themselves to the ground every 100 years. That's how a boreal forest works. And so, they built this huge town in the middle of this boreal forest, and of course it burned to the ground. And, so is that risky behavior, or is that being at risk? It's interesting when you kind of brought that up to think about it. I think you could extend this to people building into floodplains and things of that nature. So that probably changes the risk calculus as well if clients are actually doing riskier things.
Absolutely. And it's interesting, the question of where should we build takes into account many factors, one of which is the risk of it burning or getting flooded or hail destroying it or damaging it. But there are many considerations. I mean, from a sort of economics or from an economic perspective, you could say, well, if you allow insurance market forces to work perfectly, then actually there will be price signals which say it's very expensive to insure things that are built in areas that are exposed them to large degrees of damage, and therefore that disincentivizes that. There may be other factors that still encourage it beyond, nevertheless to take place. But that's one way that can happen. The other thing that we see is some things are, with hindsight, you look back and think, well, that was quite predictable. Like the example that you gave, but such is the nature of when people were doing it in the first place that they didn't think of those things. But what happens, or what can happen is, and typically happens, is after something like that, you'd say, well, we won't do that again, and there is some learning, at least for the period of your generation and your children's generation, and then maybe a generation beneath that they've forgotten, and the same thing can recur again. And then you have things like build back better. So so the example of solar panels and hail, I don't know, but for example, maybe there's a way to develop them in a way that actually makes them less susceptible to hail, or things that we can do to protect them that stop that.
That's like homes in Florida can be built to be hurricane proof, right? You see these towns where the whole town's gone, yet there's like 5 houses standing, and it turns out that they were triple engineered so that they can sustain it. And in this book, Fire Weather, one of the sort of contributors to the disaster was building houses with particle board that is made by gluing together wood chips. Well, that glue is like crazy flammable, right? So how do we rethink how to build houses in that area? Because of course the whole town's been rebuilt. They didn't abandon the town, right? They rebuilt it, but yet the forest will catch fire again. It's a certainty. So really interesting. So to the extent that you're using technology to build in risk models. Are past events good predictors, or have we had to rethink using historical data to predict future data? Is there a discontinuity between those two that makes it maybe not quite so reliable?
So I'm a great fan of Mark Twain, and he has any number of great, phrases that you can reel out for any situation. So one of his was, history doesn't repeat itself, but it rhymes. And I think the question I'd take from that is, well, to what degree does history rhyme when we consider things like cat events? History is the obvious foundation and starting point for trying to calibrate a model where you want to forecast what could happen, different scenarios, and what we see is that those cat model providers, there's a number of different ones out there. One of the things that they do is they provide climate overlays. So where they say, let's take models that we've calibrated to historical events, and let's overlay that with what could occur. So essentially another sort of the impact of the climate under different scenarios. So if the world was hotter, for example, and then that's a means of quantifying another way of looking at the world. And I suppose stepping back, for any kind of modeling problem where you're looking to model something which is inherently uncertain, as it is in this case, then a good way to look at it is to say, rather than there is a model with the answer, a much better way is to say, well, there are multiple models that have different answers, and by comparing these and by thinking about how they do things differently and what they're telling me, I can make some understanding and I can form some view. That is a healthy way to interrogate it, rather than just
classic, Monte Carlo analysis, right? So run 1,000 versions of the model and see where the distribution of risk lies. Yeah,
and then applying that to models. Have multiple ones of those.
So Sam, on that, and we've talked about data in the context of historical data, so where events have occurred and using that in modeling. In recent years, there's also been, and this is not just climate related, but there's a parallel there where there are IoT devices or monitoring devices that are put in place. Now, obviously, the easy one to think about is when you do it on equipment to monitor, but there are those types of devices that are used to monitor movement or tremors in a building, potentially to be predictive of how that building would respond in an earthquake, or what is occurring that could lead to an earthquake. Similar on wildfire risk, et cetera. And I'm just curious about, I'll label that, for lack of a better description, as real-time data that you could be getting in. How does data like that, where you're seeing maybe a baseline of activity or characteristics that then leading up to an event, you see changes, how is that data being incorporated into modeling today and potentially moving forward?
So the traditional way of selling most insurance policies is from a P&C perspective, so property and casualty, is they're a 1 year policy. We see different policy durations for things like more pay as you go for drones, or for increasingly for cars. So we do see a deviation away from that, but a lot of the P&C industry is still sold. The traditional part of it is still sold very much with 1 year policies. So being able to take real-time updates of those kinds of, for example, building tremors, is useful from a testing perspective of how big is this risk generically, but generally not so useful from what's going to happen over the next year perspective, because it is so real-time. One of our clients uses sensors for modeling the temperature of sensitive cargo, and they take that and they're able to identify has it moved beyond tolerance, and whether there should be a loss or not. And that's helped them with things like identifying that although the refrigeration stopped working for a while, actually it still remained within bounds, and therefore it wasn't a loss. So they didn't have to throw it away for things like sensitive drugs that they're transporting. So it helps with loss mitigation, and also helps with the actual paying of the claims because they could be paid immediately. So rather than waiting to go and to inspect it and say, is there a loss here? No, they know immediately, and the insured can be paid out straight away. So it helps with that speed of service and response, which is something a bit different, I think, tangential slightly to what you were asking about.
What role do you think government and regulatory bodies play in helping here? Because some of this data is sort of perhaps only can be assembled by, non-commercial entities, and how does that play into, both the things we've talked about, which is insureds that are exposed to risk and insureds that are behaving risky. And you look at what's going on in Florida and, California with wildfire risk, and how the government's had to step in and create, super tiers, from a reinsurance standpoint and all of that. But that's more of sort of a structural question as opposed to a modeling or technology question. But what role does the government play in these things?
I see this very much as a two-way partnership between industry together with, or a multi-way partnership, industry and data providers, government agencies, all of them working together. So the governments and data providers have the scientific knowledge and the data on extreme weather events. And insurers take that, and capital vendors take that to improve hazard modeling. So that's the basis for adjusting event frequency and severity. So as you think about what's going to happen in the next year, allowing for things like El Nino or La Nina, that will be taken from predictions that are made by government agencies. And the insurance industry then plays that back to those government bodies by telling them what kind of data is needed. So, for example, we've seen where meteorological agencies are very concerned or very focused around the central events. So, in insurance terminology, that's what that really means is events that are fairly mild weather, if you like, but still ones they're trying to predict. Whereas from an insurance perspective, they're not ones that bother them at all. What they care about are the really extreme events. And then we also see that partnership and interaction in terms of defences that are built or regulatory standards that are set by governments. And then the insurance industry will model those. So, for example, if there are new flood defences put in place, then insurers will want to take account of that. Or if there's new building codes in terms of how after earthquakes, then insurers will want to model that. And then insurers also play their part in terms of developing and building back better. So building, reconstructing, but in a way that is less susceptible to loss.
So you touched there, Sam, on things that the insurers are helping to push or do. Tom's question was about what role do regulators play? There's also in recent years, in my view, been a push by insurers to be more proactive, provide more services or capabilities to be a true partner and engage with their end insured before a claim occurs, right before there's a loss. And so how do you think about Aon's role or the insurance carrier's roles in helping to educate the end insured on risk, how to be proactive to help mitigate that even from their perspective so that even if there is a loss, it's reduced in terms of severity?
That's a really good question. And we have seen insurers who are proactively taking steps to help their insureds with loss. So, for example, there's a notification there's going to be some flooding, and the insurer sends a text message to their customers to say, move your cars. There's going to be flooding in your area. You should drive them out of the way. So, there's that element that's really a transformation of the insurer from we're here to pay out after you've had a loss through to we're here for risk mitigation and to help you prevent having a loss in the first place. We also see the role that insurers play in terms of where we've got pay-as-you-go insurance. So things like telematics is able to track the price of the insurance varies depending on the characteristics with which the risk characteristics of the driving of the driver.
We certainly can't get through a podcast without talking about AI. So maybe the final question of our conversation here, if you could sort of maybe provide some summary thoughts on how AI is impacting this space and maybe to what degree, are we in the early days of that, the middle days? Like, how do you see AI's contribution or benefits in sort of understanding environmental risk and managing that risk?
There's a few layers. So there's a generic layer where I see AI helping insurers to provide a better service to their customers. And that applies regardless of the type of insurance or the nature of the perils that they're exposed to, whether it's climate related or catastrophe perils or anything. But I see AI helping with data ingestion, with claims processing, with the ability then for insurers to quote more quickly, for them to be able to offer to policyholders what they should, the contracts that they want to have, to be able to ask less information from policyholders. Maybe not so much AI, but rather the augmentation with third-party data, but reducing the burden on the customer to provide data, but instead taking external data sources, to improve claims processing and claims servicing through the use of AI to identify are there suspicious characteristics, and having ruled or having classified it as low to be able to pay more quickly, to make the use of technology to be able to send in photos and to be able to process claims without needing to send a person to go and inspect a site, and to help with the management of insurance companies, the prudential management, which translates into less likelihood that they blow up and customers are left high and dry. So I see AI as a means and data and extra data as a means to improve the insurance industry's delivery of the core product. When I think about AI specifically in the context of climate, so if I look back at what is AI, it's a means to analyze a data set and to come up with predictions of what could happen. And the effectiveness of that depends upon how representative that data set can be of what could happen. So the more predictable or the more representative the data, then the better the model. For something like climate, one theory I've got is that we will move away from these one-year policies to something that is increasingly more short-term or more tailored to customers. And with that, I can certainly see how AI can be used to tailor and to model and to predict risk characteristics in a more real-time way. I think I see AI as part of the future of reimagining what insurance looks like, rather than specifically for so much on affecting climate and its change.
Well, that's a great place to end on. We've been talking to Sam Worthington, Managing Director of P&C Technology at insurance leader Aon. Sam, thanks so much for the conversation. Really, really, really interesting today.
Well, thank you, Tom, and thank you, Michelle. I've thoroughly enjoyed it.
Great.
Same
well,
here.
Just wrapping up, I'm your co-host, Tom Wilde.
I'm your co-host, Michelle Gouveia.
And that's it for Unstructured Unlocked today. Thanks so much.